Peter Cecchini joining us. He's the founder at Alpha Omega Advisors. Peter, thanks for coming on the show. We got a lot to talk about today.
We do, Oliver. Nice to see you.
So firstly, we've got this major rally back. What do you make of this, Peter? I know you're a big picture guy, but obviously watching the short-term dynamics are pretty gripping right now, where we just fell apart at the open, 50 points in the S&P in like 10 minutes, and now dip buyers have been storming in all afternoon. What does it mean to you?
Hashtag buy the dip, Oliver. That's what's trending.
So the Reddit army came to work.
Look, it's not possible for me to get inside the head of a lot of the market participants that are day trading right now. I think that is the mentality. I think there's a reason for the meme that stocks don't go down, just buy. And I think that's perhaps, what do I know, but perhaps that's what's driving the action today.
So Peter, what's happening is a very clear preference, even when we were down and while we're up too, that reopening stocks and back to normal companies are doing a lot better. High growth names are doing a lot worse. Do you think that this is just a short-term kind of reset of some of that froth, or are we looking at a potentially new regime emerging?
Well, I think that does make some sense. And to take that another step further, I'm actually something of a fan of commodity-sensitive cyclicals here. I think the problem right now across the board, more or less, is valuation. Valuations are excessively high relative to prospects for earnings. We're at 22 times 2021, and the reliance upon blockbuster growth into 2022, I just think, is going to be met with tears. And one of the reasons for that is, notwithstanding the stimulus, which obviously we're going to talk about, the trajectory for earnings growth prior to the pandemic was not very good. S&P earnings were flat year over year, 18 into 19. Loan growth was contracting at the end of the year. No one remembers it, but we had a yield curve inversion that the Fed fixed up pretty quickly in 2019. So growth was slowing, earnings were slowing, corporate profits for all companies, not just public companies, were actually down somewhere between 5 and 7%, depending on how you measure that. So I think valuations are way ahead of themselves. I've been saying that for a while now, for that matter, but it hasn't mattered because it's really been about retail flows into the market, on a presumption that the Fed and fiscal policy in combination will support equity values.
Peter, it seems that that valuation case, one could argue, will finally have some toll on the market if rates are going in the opposite direction that they have been for 10 years. The sustainability, and longer really, but just within this bull market, the sustainability of the trend for the 10 years since August, it seems like a lot of this comes down to just whether one thinks it will be disruptive at 1.3%, 1.5, 1.6, how quickly it goes from 1.3 to 1.6 or 1.6 to 2. I mean, is that really what this comes down to, Peter? Is that kind of the magic that will be able to determine what's going to come next if you can figure out where the market's responsiveness is to the bond?
Yeah, look, since the election, I've been talking about the risk to higher yields. The really important contrast, though, between what happened in late 2018 and now is the way the Fed has anchored its expectations now relative to back then, when it was basically, if you remember, on a path to trying to normalize its balance sheet and tapering. That's a very different stance than it's taking currently. And so, look, inflation is important to Treasury yields, but ultimately, what higher long yields are really more about is what the Fed is going to do next. And higher yields indicate some uncertainty about what the Fed's going to do next. And that uncertainty is obviously around the Fed needing to hike because it perceives inflation as a greater risk than the risks to growth. And just one last point on that, and I think it's very important. When long rates rise, if they rise enough and the Fed continues to say, we're going to keep Fed funds low, creates an arbitrage, right, where you can fund short to buy long. And that's precisely actually what QE is. The Fed funds short to buy longer dated treasuries, transforming that longer duration into shorter duration. And it does that by creating excess reserve liability on its balance sheet and then buying the treasury asset and parking it on the other side. So at the end of the day, it's going to be a matter of how the Fed weighs which is worse, inflation or growth.
What if, Peter, we have a scenario where the Fed stands by their promise, they don't actually hike, and the short term of the bond market still is suggesting that they're not going to hike, right? We've got that real steepening of the yield curve. But does the 10-year alone have the ability to damage the prospects for stocks and change the way investors think about how to allocate? Could that on its own kind of move dislocated from the Fed's plans to hike rates? Do you think that we could get a 10-year that moves quickly, even if Powell is not specifically saying he's going to hike?
Yeah, well, there are 2 points there. The first is that they're not sort of independent considerations, right? Because long rates are actually impacted by second order effects by short rates, and they're the geometric average of short rates, in fact. But all of that said, I think the answer to that is yes. And if you go back in history and you look at the big moves that have corresponded to equity market risks off, the correlation is much better when you look at the long end of the curve, that is, when you look at 10-year yields, than when you look at Fed funds. And it's actually kind of counterintuitive, but at least based on the work I've done, that stands true. So the answer to your question is yes, but with a big caveat, which is that I think the Fed understands that, and it stands at the ready with its infinite QE tool to make sure that long yields don't get too far out of control.
Peter, just real quick, we're looking at the closing bells. I want to get one more question from you before we let you go. As we wrap up the session, just unchanged for the S&P to the upside, though. A pretty nice comeback for the NASDAQ. Didn't quite pull it off. Still technically lower on the day, but obviously shaved off almost all of those losses and a pretty epic comeback. This is more on the stock kind of prediction side, Peter, and I don't know how accustomed you are to price targets, et cetera, nowadays, but when you look at rates finally playing a role here, and some of the big leaders like Tesla break down a little bit on the chart, what do you look for to see if this is actually a topping pattern or something close to it?
Well, I'll tell you, as you know, I was a strategist at a mid-tier investment firm for a long time, and I was sort of forced in a way to proffer an S&P target. And one of the pleasures of of doing this myself now is that I don't have to do that anymore.
What are the tools you look for to see if this is a top, Peter? Anything from the dot-com days that you're going to be looking at? Anything like that?
Yeah. No, clearly. Look, there is, to John Galbraith's book, there is euphoria in markets now, and we see it all over. We certainly see it in pockets. We saw it with the short squeezes in GameStop and other names. We see it in the valuation of Tesla. And frankly, and perhaps I just don't get it, Oliver, but I think we see it in Bitcoin too. You can rationalize Bitcoin at any valuation or any value level you want. There's no way to analyze that. It's a purely speculative instrument. And often that speculation comes when people fear inflation because they don't feel like they can put their money in anything else that's going to appreciate. So I think the euphoria is here, and it can last a lot longer than anyone expects, and I think it has, for that matter.
Okay. Peter, appreciate the thoughts as always, and looking forward to more. Thanks for joining us here on Market on Close. Peter Cecchini, founder at Alpha Omega Advisors, the thoughts on the connection between rates and the market.